If you answer yes to any of these 6 questions, don't invest in property. And I know that sounds strange since my company helps Kiwis invest in property and I'm here giving you reasons not to invest, but that's because if you get this decision wrong, you could lose hundreds of thousands of dollars, like this investor who lost 770 grand in just 18 months. So to avoid that happening to you, make sure you answer all these 6 questions honestly. And I've actually put together a free scorecard that goes way deeper than I can possibly cover in this video with a bunch of extra questions. It's called the Reality Check Scorecard, and if you want to fill it out while watching the video, the link's down in the description. And that starts with, are you planning to buy the property and sell it within 7 years? Now, if you answer yes, then investing in property might not be the right fit for you. Now, this is going to surprise you. If you buy a property and sell it just a year later, you have about a 30% chance that that property's actually gone down in value. Hold the same property for 3 years and you've still got a 21% chance that the property's gone down in value since you bought it, about a 1 in 5 chance. But hold that same property for 10 years and the chance that your property hasn't gone up in value drops to just 8%, and then 2% if you hold the property for 20 years or more. So if you buy and sell a property really quickly, there is a much, much higher chance that you lose money compared to if you just hold for the long term. As with a lot of long-term investments, the longer you hold, the more certain you get. Now, there is an exception to this. If you're flipping, so buying a rundown house, doing it up and selling it within 6 months, that is a completely different strategy. But for most Kiwis, if you're not prepared to hold for at least 7 years, don't invest. The second question you need to ask is, are you already sorted for your retirement? So in my book, Wealth Plan, I introduced this idea of your wealth gap, which is the difference between the money you need to retire comfortably and what you're currently on track for. Now, if you're already investing enough for your retirement, if you're financially sorted or are on your way to it, then not only do you not need to invest in property, you might not need to invest in anything. Otherwise, you're just taking on extra risk for a reward you don't actually need. Now, just last week, a couple of investors came and saw one of my financial advisors. They ran the numbers, calculated the wealth gap, and the advisor said to them, looks like you don't need to invest in property. You're already on track to retire comfortably, so enjoy your life. You probably don't need to buy another rental property. Now, like all of these questions, there is an exception to this, which is if you've got oodles of money and you want to buy a property with a very low mortgage when you retire to just live off the cash flow, then property could still be part of that retirement strategy. But if you're using property to build wealth and you've already got enough wealth or you're on track for it, well, you can probably stop. And if you're finding this useful, do me a quick favor and hit the like button. That's how I know which videos I should do more of, and honestly, it really helps with the YouTube algorithm. Subscribing, that helps too. You guys have already helped us build the largest property investing community in the country, and we're on our way to growing this channel to 50,000 subscribers. And if you do already subscribe, the next question won't surprise you, which is, are you expecting the rent to cover all of the costs of that property on day one? Now, if the answer is yes, property might not be the right fit for you, because Velocity, one of New Zealand's major data companies, did this study and showed that only 26% of properties earn enough rent to cover the mortgage on day one. And that's even before you pay the rates, the maintenance, and the insurance. So if you look at some of our major cities like Auckland, it's actually only 1% of properties earning enough rent to just pay the mortgage. Now, that assumes you're using the no cash needed method and borrowing all of the money to buy a house. So if you buy a rental property with a big cash deposit, then your mortgage will be lower, you'll pay less interests, and the property is more likely to have positive cash flow. But when you're starting out in property, investors often do need to top up their properties, and then over time, as rents rise, the mortgage stays the same and the cash flow tends to improve, and eventually it often flips positive. But if you're not prepared for that, that's another sign that property might not be the right fit for you. And that takes us on to question number 4. And I want to get a little more specific here, because if you had to top up a property by, call it $200 a week, would that cause you financial stress? And would it force you to sell the property? And the reason I ask this is that let's say you owned a property that was actually cash flow neutral. So it's washing its face, the rent's covering all of the costs. But if you've got a $500K mortgage and interest rates go up by 2%, that would increase your mortgage costs by about $200 a week. And it's not like you could just say to your tenant, oh, sorry, my mortgage has gone up, it's more expensive, you've got to now pay an extra $200 a week in rent too. Well, that money, that extra money going towards the mortgage cost, that's coming out of your own pocket. Now, over time, the property might go up in value, interest rates might go down, and you might make a lot of money from investing. So I'm not asking if you'd be happy to top up the property by $200 a week, but could you handle it? Or would you have to sell in that worst case scenario? Because if a $200 a week top up is going to break you, then don't invest. You might need to build your buffer first. Now, I've just hit you with 4 solid reasons not to invest in some of the biggest risks in property, but you're still watching, which means you're probably still thinking about property. And that might be because although property has risks, if you get it right and stick in it for the long term, it can change your life. About 10 years ago, Darren and Lynn, this Kiwi couple from Tauranga, they started working with my company Opes, and they were almost mortgage-free on their home, and they liked spending up on travel and motorsport, and now that their mortgage was paid off, they're really looking forward to spending some more money on that. But then Lynn hit pause and said, well, we really need to stop frittering all of our money away and to do something with it. So they spoke to their bank, they found 2 properties, couldn't decide between them, so they ended up deciding to buy both, and a few years later they bought a 3rd investment property. Now today, even after house prices have dropped from their peak, those 3 properties are worth $660,000 more than they paid for them. And when I talked to Lynn, she said to me that there's no way they could have saved that amount of money. So the questions I'm asking you in this video aren't meant to scare you off. They're meant to just make sure that if you do invest, like Darren and Lynn, you go in with your eyes wide open, ready for that long-term game. And speaking of the long game, that takes us to question number 5, which is, what would you do if you bought a property and over the first 2 years of owning it, it went down in value by $100K? Would you sell and get out of the market, or would you hold on and hope it recovers? Now, every investment has risk, and property often sits somewhere in the middle. It's riskier than bonds or term deposits, but it's typically considered lower risk than shares because share values can go up and down wildly in a single day. But there still is risk. I mean, during the most recent downturn, New Zealand house prices dropped 17.8% from peak to trough. Now, if you bought at the peak of the market, your property could easily have lost 100K or more, at least on paper. Now, if you can hold on for the long term, investors generally do okay. So Cotality releases this excellent report where they split people who have just sold their house into 2 groups. And in their most recent report, the first group made up 88% of sellers. Now, these guys are people who sold their house and made a profit. So they sold their house for more than they bought it for. The second smaller group made a loss and they sold their house for less than they bought it for. Now, what do you think is the number 1 difference between these 2 groups? The people who sold at a loss held their properties on average for just under 4 years. The people who sold at a profit, they held onto those properties for a median of 10 years. For a median of 10 years. Now, that's not to say that if your property goes down in value that you'd be happy about it. You can be really hacked off and annoyed that that happened, and it happened to me too. But would you call the real estate agent? Would you put a for sale sign up outside the property to sell it? If yes, then property might not be right for you. And the last question is the one that you need to be the most honest about. Are you just buying property because it feels right? Because it feels like the way that Kiwis tend to invest? Are you doing it because you want to feel like you're a member of some exclusive property investing club? Well, if that's you, you might be sleepwalking into a really bad financial decision. I mean, remember that investor I mentioned at the start, the one who bought a property and sold it 18 months later for $770,000 less than they bought it for. Well, it turns out that happened because while they had a plan to renovate the property, they got the renovation costs wrong, all while property prices plummeted, so they couldn't make the numbers work and they ended up taking an absolute bath. And this is a trend I see where people buy property only thinking about the good sides and what could go right without at least considering what could go wrong as well. But feeling like a property is a good investment and a specific property being a good investment are 2 Very completely different things. And if you want to go deeper on this, make sure you download that reality check scorecard, because it takes the 6 questions from this video and breaks each one down further so you can create your own score and see if you're ready to invest. It's free, takes about 2 minutes. The link's down in the description. But if you answered no to most of these questions and you're thinking, okay, I might be ready to invest, then make sure you watch this next video where I show you what I do if I was starting out in property in 2026. Click the video on screen and I'll see you in there.